Today, we'll be discussing one of the most important aspects of real estate investing: financing your first investment property. Whether you're a beginner or an experienced investor, understanding different financing options is crucial. In this video, we'll present you with 10 ways to finance your first real estate investment property. Let's get started. Number 1. Personal savings. The first and most straightforward way to finance your first investment property is by using your personal savings. Saving up a substantial amount of money can give you a head start in purchasing a property outright or using it as a down payment. Not only does using personal savings eliminate the need for financing, but it also provides a sense of financial security. By having a significant amount saved up, you can reduce your reliance on external funding sources and potentially avoid paying interest on loans. However, it's important to strike a balance between investing your savings and maintaining an emergency fund. Real estate investments come with their own set of risks and expenses, so it's essential to ensure that you have enough savings to cover any unforeseen circumstances. Additionally, consider consulting with a financial advisor to determine the optimal amount to allocate towards your real estate investment while maintaining a healthy financial cushion. Number 2. Traditional bank loan. Another common option is obtaining a traditional bank loan. This method requires good credit and a down payment, usually around 20%. Banks typically offer competitive interest rates and long-term repayment plans. When considering a traditional bank loan, it's important to understand the requirements and benefits it entails. Having a good credit score is crucial as it demonstrates your ability to manage debt responsibly. A down payment of around 20% is typically expected, although some lenders may offer options with lower down payment requirements. Traditional bank loans often come with competitive interest rates, allowing you to minimize your borrowing costs over the long term. It's essential to shop around and compare loan offers from different banks to find the most favorable terms for your investment. Keep in mind that the loan approval process may involve thorough documentation and a review of your financial history, so be prepared to provide the necessary information to the lender. Number 3. FHA loan. FHA loans are specifically designed to assist first-time homebuyers and individuals with lower income or credit scores. These loans are backed by the Federal Housing Administration, which provides lenders with added assurance and allows them to offer more favorable terms. One significant advantage of FHA loans is the lower down payment requirement, often as low as 3.5% of the purchase price. This can be a significant benefit for new investors who may not have accumulated a large savings account. However, to qualify for an FHA loan, you must meet certain criteria, including having a steady income, meeting specific debt-to-income ratios, and using the property as your primary residence. It's important to consult with a lender experienced in FHA loans to determine your eligibility and understand the full requirements and obligations associated with this type of financing. Number 4. Hard money loans. Hard money loans can be a viable option for real estate investors who may not qualify for traditional bank loans due to their credit history or other factors. These loans are typically provided by private investors or companies and have higher interest rates compared to traditional loans. What sets hard money loans apart is that they primarily focus on the value of the property being purchased rather than the borrower's creditworthiness. This means that even if you have less than perfect credit, you may still be eligible for a hard money loan based on the potential value of the investment property. However, it's important to note that hard money loans often have shorter repayment terms and stricter loan-to-value ratios, so careful consideration of the property's potential profitability and exit strategy is crucial before pursuing this financing option. Number 5. Home equity line of credit HELOC. A home equity line of credit, also known as HELOC, can be a useful financing option for real estate investors who already own a property. With a HELOC, you can leverage the equity built in your existing property and access funds for your real estate investment endeavors. This type of financing works similarly to a credit card, where you are given a credit limit based on the value of your home's equity. You can borrow from this line of credit as needed and only pay interest on the amount you utilize. HELOCs typically offer flexible repayment terms and can be a cost-effective way to finance your first investment property, as the interest rates are often lower compared to other financing options. However, it's important to be cautious and use the borrowed funds wisely, considering the potential risks and obligations associated with leveraging your property's equity. Number 6. Seller financing. Seller financing can be a creative and flexible option for financing your first real estate investment property. In this arrangement, the motivated seller essentially becomes your lender, allowing you to make monthly payments directly to them instead of obtaining a traditional loan from a bank or financial institution. This type of financing can benefit both parties involved. As the buyer, you may have more lenient credit requirements and the opportunity to negotiate favorable terms, such as a lower interest rate or a longer repayment period. For the seller, offering financing can attract a wider pool of potential buyers and provide a steady income stream. However, it's crucial to conduct thorough due diligence and ensure all legal and financial aspects are properly documented and agreed upon to protect both parties' interests. Consulting with a real estate attorney or professional is highly recommended when pursuing seller financing. Number 7. Partnerships. Forming a partnership can be a strategic approach to finance your first real estate investment property. By joining forces with a partner, you can combine your financial resources, expertise, and skills to maximize your buying power and enhance your chances of success. Each partner can contribute funds towards the purchase, which may include the down payment, closing costs, and ongoing expenses. Additionally, partners can bring diverse knowledge and experience to the table, complementing each other's strengths and minimizing individual weaknesses. It's crucial to establish clear partnership agreements and define roles, responsibilities, profit sharing, and exit strategies to avoid potential conflicts. Communication and trust are key in maintaining a successful partnership, so ensure that expectations and goals are aligned from the beginning. Overall, partnerships can provide increased financial stability, shared risks, and shared rewards in real estate investing. Number 8. Private money lenders. Private money lenders play a crucial role in real estate financing, especially for investors who require more flexibility or have unique circumstances. Unlike traditional banks, private money lenders are often individuals or organizations that specialize in real estate investments. They can offer more lenient criteria and expedited funding processes, making them a viable option for investors who need quick access to capital. Private money lenders assess the investment property's potential profitability and the borrower's exit strategy rather than solely focusing on creditworthiness. This allows them to provide financing options to individuals with lower credit scores or non-traditional income sources. However, it's important to carefully evaluate the terms and interest rates offered by private money lenders, as they typically charge higher interest rates and may require shorter repayment periods compared to traditional loans. Thoroughly vetting private lenders and seeking professional advice can help ensure a successful partnership and secure financing for your real estate investment property. Number 9. Crowdfunding. Crowdfunding has revolutionized the way people can finance their first real estate investment property. Through crowdfunding platforms, individuals can pool their resources and invest collectively in real estate projects. This method offers a unique opportunity for investors who may not have substantial capital but still want to participate in real estate ventures. Crowdfunding allows you to contribute a smaller amount of money, which is combined with investments from other individuals, to fund a larger real estate project. It provides access to a diverse range of investment opportunities, including residential, commercial, or even international properties. However, it's important to conduct thorough research on crowdfunding platforms and carefully assess the projects and their associated risks before making an investment. Additionally, ensure that you understand the terms and conditions, potential returns, and the platform's track record before committing your funds. Crowdfunding can be an accessible and exciting way to finance your first real estate investment property while diversifying your portfolio. Number 10. Self-directed IRA. Utilizing a self-directed individual retirement account IRA can be a strategic way to finance your first real estate investment property. With a self-directed IRA, you have the flexibility to invest in a wide range of assets, including real estate. However, it's vital to understand and comply with the guidelines set by the IRS to avoid any penalties or disqualification of your retirement account. Working with a knowledgeable financial advisor or tax professional who specializes in self-directed IRAs can provide valuable guidance and ensure compliance. They can help you navigate the complex rules regarding prohibited transactions, disqualified persons, and the necessary documentation for real estate investments within an IRA. By leveraging your self-directed IRA, you can tap into the funds within your retirement account to purchase an investment property, potentially benefiting from the property's appreciation and generating rental income while still enjoying the tax advantages of an IRA. And there you have it, 10 ways to finance your first real estate investment property. Remember, each financing option comes with its own benefits and considerations, so do your due diligence before making a decision. Whether you choose personal savings, bank loans, or alternative methods, always assess your financial situation and align it with your investment goals. Thanks for watching. Kindly subscribe to our channel, give us a thumbs up, and share with family and friends, and we'll see you in the next video.